Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Ernest Sweat. You ready? Let's dive in.
Today on Swimming with Allocators, we're speaking with Alex Edelson, founder and GP at Slipstream Investors, a DC-based VC fund of funds that invest in pre-seed and seed funds, many of which are emerging managers, and in their portcos. Slipstream prides themselves on investing in top early-stage emerging venture capital funds. Before starting Slipstream, Alex was the COO and general counsel of QED Investors and chief of staff to Nigel Morris, who co-founded Capital One. So with that, we're really excited to be speaking with
Alex. Thanks for having me.
So that is packed into that bio is a lot. So you're a VC turned LP, and you were the QED COO and general counsel. How did that experience, kind of from the platform perspective or operating perspective of venture, help you with your strategy in Slipstream?
Yeah, it's a great question. I mean, it's a big part of why I started Slipstream in the first place. Like shaped the hypothesis and kind of everything I've done. And so, yeah, I guess it all started with a few observations there, but like I was very fortunate there to be involved in a lot of things. I didn't have a narrow role. And so I got to touch and engage with a lot of parts of the business. And so I learned a lot about how to build and run a venture firm and what it takes to generate great returns. That now, like, big caveat, there's not only one way, but like I learned the way that we did it there, and that was really helpful. And so, yeah, it was mainly like, a few observations that stood out to me, and that I think was because I was in a unique seat that I developed, the thesis for this. And so the first was like, man, many of the best performing funds aren't the big brands. They're like these small early stage funds, and a lot of them are emerging managers. That was not what I expected as I was learning venture. Like, that was not intuitive to me. And so on the other hand, it was like hard to scale a venture firm. Like, it seemed like, man, you get these big funds, you have to get more ownership, you have to get, like, you can't get enough ownership to some extent in enough winners, and the wins aren't big enough. And so it's just hard to generate the returns on these big funds that you see, some of the best performing smaller funds, these emerging managers generating. And that was surprising to me. And I saw that because we were growing and we were also working with these smaller funds and we were studying our past. And so you can sort of see those portfolios and how they evolved and how those generated great fund level returns. And the second thing that I was seeing was like a lot of people seemed to struggle to evaluate these smaller funds. And it seemed like that was in part because they had limited track records. People just didn't know how to evaluate them. And so I was hearing from all these people who have done venture at a really high level at QED, and these founders who have interacted with QED and a lot of other venture firms and picked QED over other venture firms in many cases, and have worked with QED in many cases for a long time and had really rich feedback. And so you're just hearing all these things about what a good early stage venture firm is and what it takes to generate returns. And what was interesting was it's not track record. It's qualitative characteristics. And when the founders and the VCs, you can test for those. And then, what the next thing was some of the emerging managers were starting to reach out to me and thought I could help them, which, was a little confusing because I was, a lawyer before that. And I worked at a startup that didn't work out. And I was just you guys have a venture firm, you've done it, you raised a fund, how can I help you? I don't know what I'm doing. I'm kind of just learning right now. And I'm not sure I'm some authority on this. And the learning was people think really highly of QED. And in my role there, I was learning and I was developing an expertise. I guess I felt like an imposter, but some of these folks looked at me and thought I could be helpful in building their firms. They thought they could source, pick, win, add value, or they wouldn't have started their firms. But did they all know portfolio construction or investor relations, or what information might be helpful to track now that might be actionable in a few years? And just like if you were to step back, it's like these people seem to like, I was building a flywheel in that community, like slowly, and realizing like maybe I have a role in this community. And then like two other things that happened there. One, we had all these co-investments, and the learning there was like, you know, in these small funds, they're not going to keep investing in these great companies as they grow. Like in the great companies they invested in early, they can't keep investing as they grow. And they'll generate these co-investment opportunities for LPs, and like far more LPs say they want to do those than actually do them. And that's commonly known, but at the time that was very surprising to me, and felt like an opportunity. And the last thing was like, I was just developing strong feelings about LPs, and like we were working with our own LPs, and it was like, man, what's a good LP? What's a great LP? Like, how hard is that? And, you know, even now I feel like I maybe behave more like a GP than than other LPs. Or I should say I behave more like a GP than an LP sometimes. And so like that all like really shaped how I think about the opportunity here. And then if I were to say one more thing, it's like, I just got a sense for like how VC firms run generally. And like, they're small firms with small teams and limited operating budgets. And like, they're in these big headlines and they're in these great companies, and they have some larger than life personalities, but really like, they're pretty small businesses. And yeah, there's messiness and there's just like a lot of stuff happening that's like, sometimes it's maybe not best practices, but like it's effective for them. And it gave me a sense for just like the practical reality of what it's like at a venture firm.
Yeah, that was a question I was going to ask. What are your strong opinions about LPs?
Man. No, I think a good LP is an LP who is responsive, who wires quickly, who's transparent. I think a good LP knows that for the most part, it's they're trusting the GPs to do their job, and they're not like asking for tons of their time and questioning them and saying, like, I think that's a good LP. It is a trusting, deferential, responsive, transparent, fast moving partner. I think a great LP is someone who like challenges the fund managers, who pushes back constructively, who, if they want to meet other LPs, they want help fundraising, they can help with that. It's people who have data and perspective and insights across a longer period of time that's useful to the manager as the manager is going through difficult situations, unique cases, edge cases. Like, you know, sometimes in a fund manager's life, like they may only experience like some of these unique cases, like maybe once or twice. And then as an LP, you might see a lot of examples of these like weird edge cases.
What are your GPs coming to you to ask about these days as a good LP who has that broader umbrella perspective?
Yeah, I mean, it's so many things. And I don't mean to act like, oh, everybody needs Alex's help. Like they'd never do this without me. How could they ever make it? Like, that's not really what I mean. But I'm a sounding board and a friend, and I constructively challenge them when it feels
right. And the aggregator, like you said, like you were talking to a lot of them.
Yeah. So so the most recent topics have been things like, like recently there was we have limited reserves in this fund. Should we do an SPV? Should we do a cross fund investment? That was an interesting question. Another one is like questions about how to create momentum and urgency in a fundraising process. Like, should we build structure around this? Like, we don't want to, arbitrarily create urgency. We don't want to mislead folks into thinking they have less time than they do, but like all these fundraisers are languishing, and how do we avoid that?
Like a mortgage payment? Is that a good enough urgency?
No, I don't recommend people talk about that in fundraising. That's not persuasive to LPs, I don't think. Maybe it should be, though. Maybe it should. Often it's fundraising, like LPs that might be a fit for a particular GP. Recently, I mean, often actually talking about portfolio construction, reserves. For example, this is a common one. Like someone says, we're going to put, 50% of our fund into our top 5 companies in the portfolio. And I'm like, okay, well, like, have you ever done that? Like, do you have a track record of doing that? Like, how early do you think you'll know? And like, will you know at the time they raise their next round? And, how long from I think it takes folks to know, and it's obviously unique to them. Like there's no one answer that's generally applicable, but in most cases, it takes a long time to know whether you have a company that's likely to be real, set aside a company that's likely to generate DPI, like that's meaningful. And so, yeah, like we talk a lot about like, okay, well then what's the reserve strategy and how big are those rounds? How much allocation do we think we can get in them? Like what needs to be true for us to preempt a round? Like, would we ever do that? Like, how have you seen that work and not work? And have you seen examples of folks building ownership between rounds, and how have they done that? And those are common questions that I've gotten, I guess, in the last, I don't know, recently.
With all the talk about value add from LPs, what advice do you give for fund managers on LPAC construction?
Oh, that's a good question. I think that the people who you want on an LPAC are people who know and understand venture, which may or may not be someone's largest LPs. I think it's common to have like the largest LPs on the LPAC. And I think you want people who know a lot about venture and can help you think through the issues that you bring to an LPAC, and who the other LPs can feel comfortable with representing their interests. But I think size is relevant. And I think if someone who's like a very big LP wants to be on your LPAC, you should seriously think about that. And it's hard to say no to that. So yeah, that's what I think. I think it's people who are long-term committed to the asset class, who you think will be involved in multiple funds. This is not just like one fund and done. And who really know the asset class.
Having helped QED scale, and here you are talking about, re-upping into follow-on funds. What do you think makes that work? What are the funds that you want to continue re-upping in because scale serves you and them?
I think the most important thing when it comes to this topic is that like folks are open and transparent with each other to the extent they can be. Like to the extent you can talk about your plans and for growth and how you're thinking about your fund size, that can help you align with your LPs, and you can talk to them about that and talk to them about their strategy and their expectations for returns and their typical check sizes and what they're looking for when they invest and how long they stay with funds when they invest and what causes them to not re-up with a fund. And I think, when you have that dialogue up front, then you can kind of work together, because some of these folks are looking for very different things, right? Like some of these LPs in the same fund have different goals, have different strategies, have different sort of strike zones for what they're investing in. And so my hope is for any GP LP relationship that like, if this goes well, we're all thinking this is like 2 to 3 funds. If it's less than that, I would hope that the LP is open about that. Like, hey, you're right at the edge of whatever strike zone is my strike zone. And if you get much bigger, like I'm probably not going to be able to invest in that fund. I want you to know that as soon as possible, ideally before I make this investment in this current fund. And if you choose because of that like I'm not the right fit for you because I'm probably not long-term, like I respect that. And you should find someone, if you can, who's a longer term LP. I think like having conversations like that at the beginning of a relationship really helpful.
So kind of your advice that you're talking about now in the fundraising environment is also relevant to one of our big audiences, which is also other allocators. And, anecdotally, I've actually been surprised over the last 12 months of all the new fund of funds that have started to arise. So the next question is about like, what was your pitch to LPs?
Oh, yeah.
Because so many times, LPs ask, fund managers, why do you need to exist? What was your answer?
Yeah. Oh, what a good question. And it's funny, like on your prior point, I have seen fund of funds enter the market over the last year or so. And I think it's great. And they're all different. Like everyone has a different angle, a different strategy. I think it's great for the ecosystem to see these folks entering. Yeah, like it's funny when I think about like why does Slipstream exist? Like I think about it in a few ways. Like one of them is what I talked about initially, which is like one reason I started this is because I felt like when I looked around, I was like, I don't see a lot of folks who are doing this who have the experience that I had at QED and have that perspective. And so they just have different backgrounds. And it doesn't mean they're not good at this. And that doesn't mean they don't know what they're doing. Like, there are so many great LPs out there. But I did feel like I had a unique perspective because QED has been such a successful firm consistently over the evolution of a category, over like during like a lot of change in venture, and they have continued to succeed. And so I did feel like, maybe I have a perspective here. And as I was seeing these folks who like I thought were great, not always being able to fundraise, I was like, well, clearly there's an opportunity. Like, does that mean like Slipstream needs to exist? Like, I don't know, but it felt like there was a big opportunity there. And that maybe I was uniquely positioned to take advantage of it. But yeah, like I step back and I think about this from different perspectives. Like if you want exposure to some of the highest performing funds in venture, it is hard to get it. You could say like, hey, there are big brands, there are tier ones, and some of those are like consistent performers and they're doing well. And that's certainly true. And like, it's hard to get in those funds. And certainly for many LPs who aren't that big, like they can't meet the minimum check size. And if they are big, like it's hard to get in. And so part of it was like, this is just like a way to offer exposure to hopefully the top performing funds in the asset class that many people just aren't getting. There are plenty of reasons for that. There are thousands of venture firms. It's hard to see if you don't have time to like sift through thousands or at least hundreds of venture firms. I think it would be hard to figure out which are the best ones. And that takes a lot of time. And then it's hard to evaluate these funds. Like they don't have much of a track record. And I think folks struggle to evaluate them. And then I think, look, some of the best funds are capacity constrained. It's hard to get into them, even if you could evaluate them, even if you could identify them, like you have to get into them. And that is not always so easy. And then the last is like, there are some groups that are just so big. They may know these are the best performing funds. They may want exposure to these small funds, but they're too big to be able to get exposure in a meaningful way. So it's like, if I have a right sized fund and I can fully dedicate myself to like meeting as many as I can, and I have a framework that I feel confident in, and I have a network of venture firms and founders and operators to help me test for that, then I might be pretty uniquely positioned here. And so that's sort of why I think Slipstream has a place in the world.
And what's right sized? Like, how do you get that access, but you can still take institutional LPs money?
Yeah, it's a really good question. And it's something I'm thinking about now. I think there's no one answer, but for me, I want to be small. I want to stay small enough so that I can get into most funds hopefully every fund we want to get into, and that even small allocations in funds that are like oversubscribed are meaningful to us. I think if I needed to write 5 or 10 or $15 million checks to move the needle on the fund, that might be hard for me to get that size of an allocation in the best funds.
So you also mentioned that this type of fund manager is really hard to evaluate. What have you learned, and what kind of criteria or secret sauce do you feel gives you an advantage at evaluating emerging managers?
So I'm typically looking for 5 things at a high level. So those are some competitive advantage unique to the team that seems sustainable. So like that's often related to sourcing, picking, winning, adding value. And it should be true in fund 1 like it's true in fund 5 or 10. Like, QED is an easy example here where like QED started investing in 2008 in fintech before fintech was a category. It was a word at a time when people thought this sector was too small to justify a sector focused fund. And they had this Capital One founding experience, and like no one else had relevant operator experience or domain expertise like they did. I mean, there were other people investing in companies that were considered financial services companies. They were so uniquely positioned. As long as they're good to founders and founders love them, then they generate this amazing flywheel in the fintech community. And that should be true today in Fund 8, just like it was true in 2008, like in Fund 1. And so that's an example of like a unique competitive advantage that impacts sourcing, picking, winning, adding value. That's the first thing. The second thing is just like high enough ownership relative to fund size that if they do well and get some winners, like the fund should do well. And if they get a big winner, then the fund should be a really great fund. The third thing I'm looking for is the best VCs at the next stage. Trust the GP, wants to see their companies, invest in their companies, wants to stay close to them. That's really important to me. The fourth thing is that founders think they're great. Founders love them. They think they add value. I mean, often, I think it's common to say that like VCs don't add value, and it's probably true. In most cases, they probably don't add that much value. I don't think that's what founders would say about the funds we've invested in. That is, I mean, we're looking for founder feedback that's like pretty specific in terms of how engaged and valuable the VCs are. And the last thing is just like folks who are hungry and gritty and resilient and who understand how long of a game this is and how hard it is, how much work it takes, and who are really motivated. Maybe they have a chip on their shoulder for some reason. But if you were to step back and you're like, well, what's happening? What's so special in each of these funds? It's like they've built some strategy around whatever is uniquely helpful, like whatever their unique superpower is. They built their strategy around that. And I think about it, in a few different frameworks. That framework is one of them. And then I think about like, the six tool venture capitalist. And it's like, can you source, pick, win, add value, get liquidity, get portfolio construction right? And so I guess I think about each one of those categories too. And yeah, when you're like, well, what's the special sauce? I don't know. I think it's just that I learned a lot at QED about how one way to win in venture and the type of feedback you hear from founders and how rounds come together and why certain people are getting access to those rounds and why certain people are missing out on those rounds and how VCs are working with their companies after they make an investment and how they source these companies and how they get liquidity, how they think about liquidity. That's, I don't know if it's special, but it's unique to my experience.
Well, it sounds like you're doing exactly what you're expecting to find in fund managers, right? You've structured a strategy around what your perspective and what's unique about your perspective.
Yeah, I mean, what's interesting is like I'm in their shoes too. I have to raise capital too, and I have to think about what's so special about Slipstream. Why should anyone pick Slipstream over some other investment opportunity? And this needs to be, uniquely tailored to whatever is special about Slipstream.
If the edge is specialization in a specific vertical, QED is like heralded as an example of like, you've got the top guys in their industry investing in tech that they can feed into their network of banks, etc. Are you now more or less interested in specialists when you see sort of the hot air come in and out of some of these areas? Like,
yeah, I mean, so it's a good question. Like my interest in sector focused funds hasn't changed as the market has evolved, because what I'm thinking about is in what sectors does a sector focused fund have an advantage? So if you're like, hey, we're a fintech founder, so go talk to a fintech founder. Hey, fintech founder, would you value having a fintech focused VC or like over a generalist? And in certain sectors, the answer is we would really love to have a sector focused fund involved. That doesn't mean they need to lead the round, but like someone involved who really understands the sector and maybe has a different perspective, understands the business, maybe can add value after investing in certain ways, like through introductions, like you mentioned, and in other ways. Maybe they can find like particular talent, like, hey, we're a lending company, and you go to QED, and QED's like, man, we have so many people who you can hire as like chief credit officer. That's really valuable. And then there are some sectors where I'm just not sure, where I just don't think sector focused funds have much of an advantage. And so that's really guiding me. The sort of trendiness or trajectory of a sector doesn't impact my interest in whether I should have a sector focused fund or not. But it could impact my interest in whether I want exposure to the sector, like my thoughts on where we are in the evolution of the category.
Now we're going to take a quick break to speak with our sponsor. On the show today, we have an industry expert and sponsor, Nik Talreja, co-founder and CEO at Sidecar.io. Sidecar helps you start and run your fund or SPV so you can focus on making deals, not spreadsheets. So you all have a unique perspective, seeing what individual, different deals are being done by your managers. Is there anything, whether it's kind of like news headlines, VC Twitter, that you find yourself with a counter opinion on or more nuanced take on?
All the time. Look,
especially
VC
that last
Twitter,
part. Yeah, yeah, especially that last part.
Yeah. VC Twitter is a world in its own, and I think there's frequently vacillation in opinions and a lot of strong opinions that aren't necessarily grounded in a reality, and the reality changes very quickly, right? So look, what we're seeing is that the reality doesn't change as rapidly as people expect. Like in good times and bad, like I think there was a lot of rhetoric over the last couple of years around a boom and like, hey, everyone should become a GP, to now no one should be a GP, right? Or hey, like right, venture is a great asset class, venture is a terrible asset class. And I think that sort of that, that type of dialogue can sometimes remove quality opportunities from the table and quality players from the table, which is unfortunate. But what we're seeing is that in a time that maybe perceived as challenging, deals are still getting done. There's still momentum. People are still building. Founders still coming out, trying to change the world in a positive way. And investors that may have been sitting on the sidelines during a pretty, frothy period of time are actually out there. They're still investing. And I think there are a lot of deals that you may not be reading about because they're backing companies that have investors that really care about them, that are happy to double and triple down. So they may not be making the headlines that you previously read about, but there's still a lot of deals getting done. And I think that's something that may be a counter opinion still, although the market has largely received some positive momentum lately. Over the last year, that was certainly a counter opinion of like, hey, venture's still a good asset class, maybe better than ever now because valuations are down, companies are still raising, deals are still getting done. And if you're sitting on the sidelines, now is the best time to get in during that, trough period. So I felt very strongly about that counter opinion about myself becoming, more active as an investor and inviting others to the party.
What areas are you seeing people leverage your platform for within specific types of deals? Are you seeing like the normal? Is it going with the wave of what we're hearing about like just AI, or are you seeing more of a variety of companies?
It's a variety of companies. I think the notion of like, sort of AI or whatever's trendy at the moment, there definitely is a large group of companies that are building in that space because there's excitement around it for good reason. There's interesting technology being developed that can be applied in new ways. However, I think the reality that we see of deals getting done is, while you might expect it to be 80% of the companies that are raising, it's a much smaller percentage of actual companies that are building in the space that are actually able to raise from very great investors. We do see that more in the late stage. So like, for example, you have like OpenAI, right? Which is like, of course, like a, pinnacle of AI, right? Or other companies similar to that, like Anthropic. Those institutions will see a lot of secondary opportunities being raised in and around those companies. But on the ground level, as far as getting in at the seed stage, Series A, et cetera, it's still a very like diverse set of organizations that are raising. Still see a healthy amount of life sciences, healthy amount of consumer technology, healthy amount of energy transition, on top of course, the trendy terms like AI.
Have you seen an increase of SPVs done on your platform? And do you think that's in line with just the market overall?
Yes, we've seen an increase in number of SPVs in our platform by a very large order of magnitude. No, I don't think syndication is the market overall. I think we're building a technology that is somewhat disruptive to how people have normally done these things that we do. As a result, we've taken market share from our competitors, and we've created a new market for those that previously couldn't start a business in doing what we do, in doing what you do, doing what I did, of creating opportunities for their community to invest in things they're passionate about. I think that the market is in a period of correction. We just happen to have outpaced the market because of technology.
What does that correction look like for the next 10 years, do you think?
I don't know, man. That I don't have a crystal ball. It's hard to say. I can tell you our personal embedded sidecar is that the technology that we're creating, right, of like simplifying and standardizing how people create investment opportunities is something I believe is over the next 10, 20, 30 years going to be from what is now a small slice of the market to a majority of the market of how transactions happen, for a couple of reasons. One, there's a wealth transition, right? Generational wealth transition from an older generation to a younger generation that is more technologically savvy, that is reading about things like commercial real estate and energy as investment opportunities they want to make through technology platforms rather than calling someone on the ground and like investing through a broker, right? That requires technology behind the scenes to support those types of investments, which require standardizing how these structures operate.
Absolutely. One thing I've also been impressed is just how streamlined and intuitive the user interface is. Nik, you're clearly out ahead of the future of venture capital. For those interested in using Sidecar's software, please visit sidecar.io/allocators. And now back to our allocator interview. Something that has come up a lot over these last couple quarters has been a term I think we forgot about, liquidity. And so I know on This Week in Startups, you talked with Jason about venture capitalists should consider every funding round as a potential opportunity to buy or sell. As an LP, tell us your reasoning for your position.
Yeah, it's a great question. Companies getting traction is great, needs to happen. Markups are great. But in my view, like this is all about returning capital to LPs. So I'm an LP, and to our LPs, like at a multiple of the amount they invested. Like that is why we're all here. And so my hope is that that is always on people's mind because that is the goal. Also, like VC is a really long game, and it's relationship based, and it's like artisanal, and there are these relationships built between founders and VCs, and I think it can be hard sometimes for folks who have been along for these journeys with founders for a long time to take money out. And I often hear folks say, well, like from a relationship management perspective, like it's I don't really feel comfortable selling into the secondary, like trying to sell secondary. And I just want people to be thinking about it constantly and maybe pushing themselves on that. Like I'm not here to tell them what to do. I would never do that. Like they are close to their companies. They manage their firms. Like I'm not second guessing them, but I do think it's important for folks to be thinking about whether they're buyers or sellers, because as another reason is like, they should know, my hope is they have a lot of information about the companies and they have an opinion about the valuation of a company at a given time. And if they feel like this may be as good as it's going to get, we may be approaching about as good as it can get for them. My hope is like maybe they're going to take action and generate some liquidity from that investment. And also like if they feel like it could get a lot better, like, hey, this company is being valued at 100 million. I think this company is on the path to being much more successful than this. Like they're very bullish on this. They're a buyer. Well, what does that mean? Like maybe that means they should be following on. Maybe that means they should be trying to do a co-investment, like bring this opportunity to their LPs. I would love to be co-investing in companies that the GPs that we're partnered with think are on a great trajectory and have a lot more growth ahead. And so yeah, my hope is that we are always thinking about it because generating returns is the goal.
Yeah, I think what you're getting at is, and I understand some of those VCs who may feel a little bit uncomfortable. But when you've, put on not only an investor hat, but now you're a fund manager, this this is the responsibilities that entail in that role. And so I've seen people get as emerging managers get really active and seeing what different LPs, what their appetite for continuing and not, and essentially being a broker based on that within specific companies or even full LP positions, because there are active fund to funds that are trying to do more secondaries. There are even like secondary strategies that are emerging a lot for an appetite to take on things.
Are you actively investing right now in new managers? And if so, how do you like to source or hear about
Yeah, I am actively investing. And it reminds me of your first question about like the operating experience from QED and like how it informs the strategy now. One thing that I remember like very vividly is just like when you should start fundraising to make sure like you're never out of the market, and hopefully so that you have a good sense for your fund size when you start investing, so you can get your portfolio construction right. And so so I'm thinking about that right now to make sure like we're ready with our next fund as soon as we're done investing out of the current fund and there's no time out of market. So yeah, like hopefully my answer to your question will always be yes, we are always actively investing. We are now. The second question, yeah, I mean, there's no wrong way to hear about managers. Like I want to meet great funds. And I think it's helpful when I meet them through someone who I know and trust. That could just motivate me to move a bit faster, but I'm looking at everything that comes in. I get cold inbound through the website or on LinkedIn. Like I respond to everything. I may be a little slower to respond to some of those, but there's no wrong way. It could be through QED. It could be through a founder I know. It could be through another LP. It could be through a fund we've invested in. That's a great way. But there's no wrong way.
Is now a good time to still be in venture?
I think this could be like one of the best times to invest in venture in the last 10 or 15 years. But I should say, like, if you're going to commit to the asset class, it's hard to time it. So I'm not suggesting like, hey, the way to do this is just like wait for the great times, like, put all your money in and then just stop investing when it's not looking good, because this is a long game and it's hard to know now when the best vintages will be. But I do think there's good reason to think like industry averages will be high, like performance metrics will be high, sort of industry wide, in this period of time, like over these next few years. But like another way I think about this is like there's not a bad time to invest in great funds. Like they're investing in particular founders who are running particular companies, and if you have opportunities to get in with great funds during what you think is a bad vintage, I would say that's a good, like you should do it, because there are great fund managers who will do well in all market conditions, and there are great founders who will do well in all market conditions, and there are great companies that will do well in all market conditions. So I say that with a big caveat, but yeah, it does feel like this could be a very good time to get exposure to the asset class.
Well, Alex, thanks for being on. It's been a true pleasure, man. And thanks for all the insights and your opinions and for what you're doing in the market.
Thanks for having me.
Thank you. See you later, allocator.
After Portfolio Tile, investing with a smile.